Okay, Alex, I'm going to click broadcast now. So you just count in 1, 2, 3 and you can start speaking, okay?
Okay.
Well, I'm going to go click it now, so I'll just stop talking now, okay?
Good morning. Thank you very much for coming in or to logging in this morning. My name's Alex Barnes. I'm head of insurance at BDO. So this morning I think we've got a really interesting talk going on. There's a huge amount going on with the COVID-19 position in the insurance market. We've got some key guys within the firm that are going to speak to you this morning. Firstly, we've got Richard Cameron Williams, who is a sort of key voice within the firm on the business interruption side. Thomas Toe, who is our head of insurance tax, is really going to cover some key tax initiatives that HMRC have got going on, and some key risks and opportunities that are sort of really affecting or potentially going on in the future. And then Charles Portsmouth is going to cover the regulatory key regulatory developments, and Tom Barford from our sort of M&A team is going to cover how he sees the broker market being affected. A few points of admin first of all. This is going to be recorded, and the slides will be available later, and those will be sent around later. All your lines are going to be muted, but we've got a Q&A function at the bottom on Zoom. So please do please use that. And let us know if you've got any issues through that function as well. So a key thing that we as a firm have been doing is thinking about, for all sectors across the economy, how the sectors are being affected by COVID-19, and we've been using a rethink model. And what this does is really just first of all look at how the sectors have been reacting first of all to COVID-19. So that was really in the lockdown phase when the sort of investment markets went wild and things really changed fast. So really the resilience phase, which is really where we are now. How are businesses and sectors reacting to that to make sure they remain strong for the future? And then the realise. So COVID-19 is changing the way we as a society work, and the economy works as well. So what is that going to mean for each sector going forward? If we reflect this on the insurance market and what we've seen, first phase, we saw the insurance market really reacting very well. We saw all the offices quite smoothly being able to move from a work from home environment, and really the investment markets affected the insurers, but the insurance market in general was able to react very well to the coronavirus pandemic. There weren't mass furloughs. There was no major issues when we came down to sign the accounts and going concern. Then the sort of resilience phase, where we are now, we're sort of seeing the markets market really develop in different ways. We're seeing some parts of the market doing very well, such as motor. Other markets finding a bit harder. Some capacity issues, but actually again, still a strong market. What's really going to be very, very interesting for the insurance market is really the realised size. So we've seen the markets react quite well to COVID-19 and able to work from home. What's the potential going forward? Will we all go back to London and work in London in the same way that we did before? Or is it going to be a longer term change for the insurance market? And also we've got to think about the risks and opportunities from Brexit as well. What's that going to mean for our market? So just moving on, I'll now pass you over to Richard, who's going to talk about business interruption.
Thanks, Alex. Just want to try and give an overview of where the industry has sort of got to following the FCA Test Case. We could probably fill about an hour's worth of time discussing it in detail, but I shall try and cover some of the key points in the next 10 minutes or so. So, brief bit about background. The FCA Test Case was initiated effectively to try and give some level of certainty around business interruption cover for COVID-19. Quite crucially, it wasn't looking at damage wordings, which most BI policies are sort of based on, but specific non-damage extensions, referred to in the case as disease wordings, prevention of access, and some hybrid wordings. A total of 8 insurers signed up, and 21 policy wordings were considered within the case. It was also felt that this would give some level of guidance for other policies that weren't specifically considered. The case was held over 8 days, just at the end of July, and the judgment was recently handed down on the 15th of September. And just want to try and give some initial comments and commentary around the outcome. So, as a sort of summarisation, the disease wordings were generally held to provide quite wide cover in relation to COVID-19. There were various arguments around the requirement for the local occurrence of the disease to then also be the causative effect of the losses. This was in some respects dismissed by the court. So where a policyholder has a disease clause in general, it should give some quite wide cover, where so long as there was an occurrence within a specified radius, they will have cover as if COVID-19 had never occurred, which is obviously quite crucial, because that was sort of one of the sort of key aspects which could have reduced the losses quite significantly. In relation to prevention of access wordings, it's very difficult because this category is very broad in the fact that there's huge numbers of alternative wordings that do get used from policy to policy. So, for example, it might be prevention, it could be denial, it could be hindrance of access, it might be based on actions advice, or it could be restrictions or the impositions by an authority, and then it can't be due to emergencies or endangerment of life or incidents. So the myriad permutations of wordings are very challenging for providing a sort of concise outcome on these wordings. But I think it's fair to say the court found the cover was likely to be much more narrow. Certainly for prevention of access wordings, this would require mandated closures. And it was also felt that where the terminology was something like an incident and where the specified radius was relatively small, it was viewed that this would only provide localized coverage, and the impact of the wider pandemic therefore wouldn't provide cover. So I think the legal teams will be picking over these ones very carefully to really see on a case-by-case basis whether cover is triggered. The hybrid wordings, are a bit of a mix of the two. They tend to require restrictions imposed and inability to use. And again, the court determined that this was quite narrow and required, again, very mandated closure. So not just, advice not to use your premises, but required, I think in some of the sort of actual legal mandated closure. So again, the good thing was that was giving rise to some level of cover, and the view was that if the policy was triggered, again the but-for scenario would be but for COVID-19, which could provide some quite wide cover. but there was the issue of whether or not the businesses was mandated to close. I think one of the largest parts of the judgment was really sort of commentary and in some respects sort of overruling of the Orient Express verdict. This was argued very strongly by insurers, where the view would be that the closure of business would be covered, but because of the wider pandemic and the impact of COVID-19, effectively there would be really sort of no real cover. And throughout, and no matter what the wording, where there was cover, the court held that it would be in a scenario where COVID-19 had not occurred. So there's a much greater chance of businesses recovering something akin to the sort of economic impact that they have suffered. If we just move on, Lauren. So, I mean, the test case was hugely impressive. You can see sort of around the world there have been other sort of cases being brought, but I think the UK test case was just very impressive in really the scope and speed that managed to achieve. I mean, the complexity of some of the issues, it really was just very impressive all around. That being said, because it was looking at policy wordings and it doesn't look at specific policy circumstances, nor does it look at the specific quantum of any cases, it's still now going to require some level of interpretation of the judgment in order to put this into action. And there's probably a few points that we feel that maybe there's still some level of ambiguity, and it's possible that either side may still appeal. And these are just sort of initial thoughts on where that may arise. So the overturning of Orient Express principles, that was argued very heavily by insurers. It was clearly a verdict that they quite like. So on that point alone, there's a possibility that insurers may seek to challenge that position as much, not just to protect or in relation to the COVID-19 business interruption claims, but wider claims. It would have quite a big impact, especially on catastrophe losses, where that is often quite a sort of key issue. In relation to the disease wordings, these are generally very favourable to policyholders. Insurers may seek to challenge some elements of it. I think the big win for policyholders was that they needed to just show that there was an occurrence of the disease within the specified area, and that would trigger the policy, but the causation element didn't necessarily then link to that local occurrence, and they will be able to claim the full impact of the disease within and without the specified area. Now, that was an area again that insurers argued hard against, so it might be an area they would look to appeal. The hybrid wordings, again, generally, a positive outcome for policyholders in that fact that there was triggering of the policies, but the restrictions imposed, the inability to use being construed so narrowly, could again be an area of appeal. And I think there's one particular area in relation to Category 5 businesses, which includes professional services firms. I think many of them felt that their workers were required by law to stay from home, and therefore there's effectively a mandated closing of the office. But the regulations did not specifically stipulate that Category 5 businesses were required to close. And certainly, we've seen from Hiscox's initial reaction, one of the reasons that it came out quite strongly, reduced its business interruption reserve following the judgment, was in their view that there probably wouldn't be any cover for Category 5 businesses, which was counted for around 2/3 of their policyholders. I think it's not quite as clear cut as that, certainly from the sort of legal minds that I have spoken to, but certainly be an area that requires some level of clarification, or if not, maybe subject to appeal. And the prevention of access, denial of access, again, it's very difficult to really sort of pinpoint this because there's such wide variety of wordings, but certainly the mandated closures, again, could be a point where some of the very strong advice that was given may be challenged to say that that was also sufficient to give rise to a prevention, or the very least a hindrance of access. So next steps, it's certainly the case that I think most of the industry is still trying to get to grips with the outcome of the judgment. There was a requirement for insurers to provide an update to policyholders within 7 days of the judgment, which would have been by last Wednesday. And from what I understand, these have mostly been holding letters, and as yet, insurers aren't quite yet engaging with policyholders who appear to have cover from the outcome of the test case. The FCA also then issued what was known as a Dear CEO letter, indicating that insurers should progress claims of the type the judgment should be paid, or at least progress claims so that can be in a position to be paid as soon as any appeal is heard. Now, what's likely to happen is insurers are probably going to wait to see if an appeal is going ahead. If so, when that appeal would be. I think we've already seen this week that there have been applications for a leapfrog appeal to the Supreme Court. So if appeal was to be heard, it might not be to the end of this year, or if not, even into early 2021. But crucially, I think they'll probably want to know what points are being appealed. And we will find out on Friday. The High Court is considering applications for appeal, so there might be some more clarity following that hearing on Friday. In fact, yesterday, there was the confirmation of the lodging of, and they have called it precautionary appeals. And as the FCA has indicated, it would appear that all parties are trying to reach agreement in principle on a range of issues to mean that an appeal is not required. But ultimately, we'll have to sort of see what the outcome of that is, and whether there are still some points that will be appealed. So there's no doubt that the test case, the judgment was very complex. It's still going to require an almost case-by-case view to really see how policyholders have been impacted and to the extent of any cover that they do have. We would hope that generally, the position will become clearer over the next few weeks, and in particular, hopefully insurers will come out and provide their position on not only their view on the judgment, but also the process going forward in order to try and sort of settle claims where possible. So, very soon, I think we're sort of seeing that hopefully the sort of legal minds have done their bit, and I think the accountants, in some respect, waiting in the wings, because at some point in time, it would seem, given the judgment, there's likely to be a number of claims that now require quantification. Some of those may be relatively straightforward, some of them much more complex, which we will wait with interest. So that's my sort of brief update on the test case, and I believe I'll pass on to Thomas.
Thank you. Good morning, everyone. I hope you're all keeping well. No doubt you would have seen last week some key announcements from the government. First one being that the Treasury has announced that the autumn budget will be scrapped this year. The government has had a rethink of how they will support the jobs market in these challenging times, and how the job retention scheme will be replaced once it comes to an end in October. So they've announced a job support scheme coming in November, which I will cover in my next slide. But where are we at the moment? The furlough scheme, as it's commonly known, will come to an end at the end of October, so 31st of October 2020. And in the spirit of its tapering off, in the final month, the government will only cover 60% of wages of furloughed employees up to £1,875. Employers will need to cover 20% of wages up to £625. What's happening at the moment is that £35 billion of furlough claims have been made so far. That's the estimate, and HMRC have estimated also that up to 10% of that, so 3.5 billion, are as a result of fraudulent or incorrect furlough claims. So we would certainly suggest to anybody who has made any furlough claims to revisit the claim, just to make sure that they are accurate. And if they're not, then certainly do report to the HMRC and repay any overclaims you've made. The job retention bonus, again, this was announced quite a while ago, but one-off payment to employers of £1,000 for every employee that was previously furloughed and who remains continuously employed through to the end of January 2021 will get £1,000. And this is still applicable even if you claim the job support scheme, which I will talk about in a moment. But eligible employees must be earning at least £520 a month on average between November and January of next year. So my next slide, the job support scheme. This was announced last week, as said, and the job support scheme will operate for 6 months from the 1st of November to the end of April 2021. This will be available to SMEs and large companies that can prove that they are still suffering a significant drop in turnover as a consequence of coronavirus. It will apply to all employees on the payroll at the 23rd of September, and they must work at least a third. So that's the important distinction, that this is a job support scheme. Furlough was aimed at people who weren't or aren't working, but this requires the employee to be working at least a third of the normal contractual hours in order to qualify. So the government will cover a third of the employee's usual wages for the contractual hours not worked, up to a limit of £700. So what that means is that if we assume that the employee is working 1/3 of their time, so i.e. 2/3 of their time is not working, then the government will cover 1/3 of their 2/3 of their time, which is roughly about 22%. So employers will be required to match this payment in percentage terms, as well as pay employers national insurance contributions and pension contributions. So again, what that means is if the government is paying overall a net 22% of the wages, then the employer will have to match that 22% for the unworked part, as well as, of course, paying for the time that the employee is working. So what this means is that the job support scheme will guarantee employees a minimum income of 77% of their earnings, with employers meeting at least 55% of the normal wage costs. Now, as you can see, jumping from October to November, where employers were paying 20% for furloughed staff and then suddenly paying at least 55% for staff in November, is actually quite a big jump. And for most brokers, and not all brokers, the staff cost is the highest or the largest cost. So this can make a very big difference. So off the back of that, in this slide, it's time. I think it's a good opportunity for brokers to rethink their remuneration model to make it less cash intensive, I suppose, and conserve cash. So we've been seeing a few share-based remuneration strategies being used in the market by brokers to conserve cash, said. So the first one being asking employees to take a salary reduction or deferment of the salary and being granted shares or options in their place. Secondly, using deferred shares or options to defer tax charges and remuneration. So in this case, this is about deferring tax payments. So again, conserving cash. And the final one is if you've got bonus plans. So again, typically brokers will have bonus plans and commissions, profit commissions, potentially replacing those with share incentives. So the key thing is about conserving cash and just revisiting your remuneration strategy. On my final slide, VAT. I'm sure most of you will know that payment on account due between the March and June of this year has been deferred, and you're able now to pay that by the end of March of next year. Last week, some good news, better news, that this payment can now be spread for 12 months up to the end of March 2022, and that can be done interest-free. So again, that's great for your cash position. And then just talking about Brexit, and sorry to mention Brexit, I know we've all been focused on COVID-19, and Brexit hasn't had much of a mention. But because of Brexit, we've seen more brokers looking to do business outside the EU, so non-EU countries such as the US and the Far East. And where we've seen them caught out in a few occasions, a few of our clients, has been around this VAT anti-avoidance or offshore looping. What that is that, for example, one broker client has started to write business in the US, so for a US insurer, but it turned out actually some of those policies that they were writing for the US insurer, the policyholder was or is a UK individuals. And unfortunately, as a result of the offshore looping rules for VAT purposes, this means that, well, I mean, usually when brokers do business outside the EU or non-EU business, they should be able to reclaim input VAT on costs. But if you've got a situation where I've just explained, we've got offshore looping, so a non-EU insurer with UK policyholders, then the insurance broker is not allowed to claim VAT on their costs. So as I said, we've had a few broker clients who've been caught out by that because they've seen the fact that the insurer is non-EU, but didn't look into the underlying contract to see where the policyholder is located. So it's critical that all brokers look at those policies with non-EU insurers to see where the policyholder is. And if you see that the policyholder is in UK, then definitely look at your VAT position and your VAT reclaims. The final topic I'm going to talk about is IR35 or off payroll workers. Certainly as a result of COVID-19, we're seeing brokers rethink their hiring strategy or resourcing strategy. So without some have a freeze on recruitment, on employment. So what they're doing is potentially using contractors to fill their short-term needs. And also we've got situations where brokers have laid off some staff, but again, turning to contractors to fill that short-term need. So with contractors, I'm sure a lot of you would have seen this because it was due to come in of April this year, but some new rules around off-payroll workers. So they were meant to come in April this year, but because of COVID-19, that's been postponed until April next year. So from that date onwards, so 6th of April 2021, in the private sector, all companies using contractors paid off payroll via personal service company or other intermediary, you will have to assess under this IR35 rules whether they are employees for tax purposes. And if you assess that they are, and bearing in mind actually the assessment criteria is quite complicated and quite long, so you've got to look at whether the company has control over the contractor, whether they use their equipment, whether they are under their direction, and whether they are allowed to work for other parties, and whether they're allowed to wear the hat and t-shirt of the company, and will have to wear the hat and t-shirt of the company. So lots of considerations there, and it's quite a difficult assessment for quite a few groups. But if it turns out that they are employees for tax purposes, and the company has an obligation to deduct PAYE and national insurance contributions. So I would certainly recommend to all groups, employers or companies who use contractors to have processes and controls in place to make sure that any contractors you do use are assessed properly, and any tax that is due to be paid is paid on time and reported. Otherwise you will be penalised. That concludes my slides. Thank you.
Thanks, Thomas. Morning to everybody. And it's a sunny autumnal day up here in North London, and I hope you will have the same wherever you might be. I've been tasked with talking about the regulatory outlook and any issues arising from COVID-19. And I've titled my slides with plus ça change, plus c'est la même chose, which when translated, I've taken to mean the more things change, the more they stay the same, because this is roughly the approach our regulators have taken, as we shall see. If we step back in time to the FCA's business plan, published at or around the same time that the current hiatus began, they were aiming to concentrate on four main themes: products and services being suitable for customer needs, customers not being unfairly excluded by digitalization or vulnerability, products being of a high quality and offering fair value and delivering what is intended at the time of a claim, and lastly, operational resilience of all firms in all sectors. I think this last point has been tested in spades over the past few months, and as Meglin Butler, an FCA Executive Director, said recently, I think it's fair to say that in operational terms, this industry has responded well. However, she went on to note that operational resilience also includes financial resilience and continue to act with integrity. I'm going to discuss financial resilience in a bit more depth later. The FCA's initial response was to allow latitude for some of the upcoming deadlines for new regulatory requirements, and in particular the changed deadlines for the application of the certification and conduct rules elements of the senior managers and certification regime. They have also been expending time and resource on the business interruption issues and the recent test case as discussed by Richard earlier. However, their recent policy update shows that they are now back on course to meet their business plan objectives. They've published recently their consultation paper on general insurance, values measure reporting. They've also set out their stall in terms of extending this reporting for many more products than are all currently covered. They're pushing ahead with their consumer vulnerability agenda with further guidance due early in the new year. And they're also contributing to the Treasury-driven regulatory framework review, partially driven by what's coming along with Brexit. In early September, they issued a Dear CEO letter, which set out firstly their concerns around the possible harm that may be found within the general insurance sector, and secondly around operational resilience. In terms of the potential for significant harm, this is seen to be set around the possibility for harm that is inherent in poor value products and inappropriate sales tactics. They identify the key drivers of that harm as being poor governance and oversight, poorly designed incentive arrangements, and business models through elongated distribution chains and poor product oversight. And this is an area businesses need to rethink in our new business world in terms of asking the key questions that address these potential issues. For instance, how are our product governance arrangements being carried on? Do they need to change? Do we need to reevaluate some products to ensure they meet the enforced changes in our customers' behaviours arising from the current circumstances? Are our incentive arrangements correct in the new circumstances, and should they be modified? How do we ensure that sales discussions are monitored to ensure that there are no issues around the integrity of those conversations? And where and what are the links in our business chain that we need to monitor? And how are we continuing to do so? And also to evidence we're doing so. This is particularly important where firms are responsible for the compliance of that link in the chain. And appointed representatives are a prime example of that potential issue. In terms of operational resilience, the FCA noted they recognise the significant challenges that firms have faced and continue to face because of the current disruption from the COVID-19 pandemic. These might include furloughing of staff and operating from home, and the resulting challenges that both of these can cause to business as usual. They noted they'd seen some excellent examples of firms going the extra mile to help customers, adding that this should assist those firms to emerge from the current crisis in a positive position. However, they recognise that other firms have struggled due to a lack of critical mass, limited access to capital, or a business model that has been unable to absorb the significant shock to the UK's economy. As a result, there's a risk that a number of firms in the FCA's supervisory portfolio might fail. Thus, they stress the importance of their guidance for firms in financial difficulty and the need for appropriate management of a firm's financial resources and for forecasting ahead. This means boards adapting or rethinking business strategy to meet the current conditions or the new normal, a term which we have all become used to. Rethinking budgets and reacting to the actual performance to date. Stress testing those revised plans and budgets, and maintaining regular cash flow forecasts, including modelling solvency capital requirements that reflect the changed circumstances of the business. Planning for an orderly exit where and if necessary, and I hope this is not the case for any of you listening today. Continuing to meet the FCA's regulatory requirements and keeping the FCA informed of any potential issues. And of course, we're going to have to face and possibly rethink about the upcoming challenge of Brexit. Whilst we know that the search for a negotiated deal which establishes our future relationship with the EU continues, we are uncertain as to what it may contain and what it might mean for insurance intermediaries. I thought, therefore, it was worth reminding you all of what no deal, as at 31 December 2020, means, particularly in case the current hiatus causes a need to rethink your current planning. The Insurance Distribution Directive governs the current relationship and sets out the definition of insurance distribution, including the fact that it covers sales through websites, etc. The UK's EU withdrawal means no passport rights, either under the existing freedom of services or freedom of establishment conditions. Therefore, UK intermediaries may no longer be able to place certain European risks with insurers. The need for appropriate authorisations in a particular EU state will be driven by the residence of the customer, the location of the risk, and the place where the activity is deemed to be being conducted. We need to remember that unlike for insurers under the Solvency II Directive, the IDD contains no equivalence provisions, so there is no potential for salvation from this particular route for intermediaries or brokers. Thus, if firms intend to continue distribution activities for either EU policyholders or on EU risks, you need to ensure you have the appropriate authorisations in place. However, these vary country by country for third country intermediaries, and it is a complex area. Lastly, and I guess that to some extent this has been removed by the current situation, staff travelling to Europe on business need to take care they're not conducting regulated activities without their having the appropriate regulatory positions. This probably also applies to conducting business over Zoom. How is the compliance officer going to monitor that? A potential rethink might be needed here. Thank you for your attention, and please submit any questions you might have, which we will attempt to answer later. I'm now going to hand over to Tom, who will talk about the changing M&A world. You're on mute, Tom.
I was on mute. Thank you, Charles. The first thing I'm going to sort of consider is really the impact of COVID-19 on insurance intermediary M&A and highlight practical areas that buyers and sellers need to consider in a post-COVID world. The first thing to highlight really is that the factors that are already driving M&A and insurance intermediaries are potentially accelerated by COVID-19. The first of which is the requirement for brokers to have scale is even greater, particularly given that potentially quite a few brokers and MGAs may be experiencing some financial pressure, particularly on the top line. That will only be exacerbated, and the benefits of being in a large organisation may well be material. obviously the regulatory pressure from the FCA that Charles has taken us through sort of continues to sort of place an increased burden on businesses, particularly with remote working. The requirement to invest in technology, including e-placement, is essential, and intermediaries are spending more and more money on those systems. And lastly, sort of MGAs are already facing significant pressure on capacity, particularly given Lloyds' drive to improve underwriting performance. This trend appears to be accelerating with, on a pretty frequent basis of high-profile insurers exiting certain lines of business reasonably frequently. In terms of how COVID is impacting intermediaries, I think the general view is that it's uneven. Certain intermediaries will be faring pretty well and moving in a relatively unchanged way, and some will be facing more severe short-term financial issues, particularly those intermediaries which focus on, for example, retail or leisure sectors. During 2020, management is likely to have been very distracted by COVID-19, particularly due to queries from customers, dealing with claims, understanding levels of cover, which clearly would have distracted from the normal business of going out and winning new clients. You've also got the potential for short-term cancellations, particularly if cover is no longer required, policies may lapse, and we've seen in a number of occasions where sort of MGAs and brokers have repriced premiums downwards due to lower activity. Particularly if businesses have been furloughing staff, there's no wage roll, there's a lower level of risk for insurers. Generally, new businesses is potentially lower. I mean, often, the underlying clients are driving that activity where they're very distracted, and going through a new business or tender process is time consuming, and they honestly just don't have time for it. And that will obviously, again, impact on client retention statistics. There is some upside, and we have seen sort of cost savings coming through, particularly on travel and entertaining, but also on some of the more general office costs, where people are looking to do things in a slightly more digital way rather than sending things out in the post. In terms of market activity, Lauren, if you move on to the next slide, I have done a little bit of analysis on transactions published in merger market over the last 4 years on the left-hand graph. So that's the number of transactions involving the purchase or sale of an insurance intermediary, and we can see in 2020 that there was a marked decline, particularly post-March 20, where there were 10 in the 3 months to March, and then there've only been 9 since March up to the end of September. This is clearly a sample of transactions. Not all transactions get fully recorded on these databases, but it's a good directional indication of what's going on. I think generally, that this is unlikely to be driven by lack of demand. I think we'll talk about some factors. I'll talk about some factors shortly. I think it's harder to do transactions. There's more uncertainty. There's a slightly greater level of execution risk, which may be delaying transactions which have been in progress for a number of months. In terms of valuation metrics, the graph on the right-hand side shows the median revenue and EBITDA multiples. These should certainly be taken with a pinch of salt. They're an even smaller sample of the number of transactions from the left. But directionally, it broadly shows that there was a upward pressure on multiples up to 2019. And it'd be interesting to see whether that's maintained or even goes slightly in the other direction into as we have more transactions completed in 2020 and through to 2021. I think broadly we are expecting the level of activity to pick up. I think one main factor is the level of private equity investment in the insurance intermediary market is quite significant. There'll be a number of private equity backers who have been invested for at least 3 to 5 years already, who will be looking for exits in later in 2020 or 2021. So we do expect the level of M&A transactions to pick up. So if we go over the page, I've set out some thoughts really about how buyers and sellers might want to rethink their approach to M&A. I think fundamentally, the approach is no different to normal, but there is an increase in execution risk, which I think means that buyers and sellers should think about fundamentally how they're going about it and the processes they're putting in place. For sellers, I'd certainly say that preparation is even more required than normal. I would certainly always recommend that vendors are very prepared, particularly around having a very clear view of the numbers, and particularly on quality of earnings. And I think this is even more so. I think there's certainly possibility of being challenged, and particularly if results have been impacted by COVID-19, being very well prepared for that challenge and explaining it, and then explaining the route back to where you were is very important. And I think one thing that sellers should think about is are there any things that they can do to help reduce the risk, particularly things like vendor due diligence or vendor assistance can certainly help take that burden off vendors. In terms of for buyers, it's really about having a really good think about the target and how COVID-19 changes the risk profile, understanding the types of risk and exposures that these businesses face, looking to sort of do enough due diligence to mitigate any increased risk, and ultimately making sure that the SPA has sufficient protection for any downside risk. I think in some cases, your buyers should really think hard about, do they need fuller due diligence and fuller investigation of certain issues being undertaken? A fuller due diligence process rather than confirmatory due diligence, could certainly reduce risk, particularly if the target is impacted by COVID. In terms of transaction mechanisms, I would generally expect that we might see more completion account mechanisms than lockbox. I think with the lockbox mechanisms, trying to define and take account of leakage would be a challenge, and I think it increases and introduces complexity and frankly cost in the process. So I think that's something that may well play out. In terms of the impact on EBITDA, I've set out some considerations on the right-hand side. So it's really around sort of cancellations, impact of declining new business, potentially declining retention, will all impact the EBITDA that's presented at the start of transactions. And ultimately, there is likely to be material uncertainty around the future. I mean, no one knows what's going to happen in terms of the recovery. There is uncertainty when the earnings recover. In terms of sort of net working capital trends, I think the biggest thing to think about is this potential stress put on working capital through delays in payment from clients. I think given the financial stress that certain sectors of the economy will be under, it's very likely, and we've certainly seen in recent work that the debtor days are being stretched, and that there'll be challenges here in setting benchmarks and net working capital targets for the purposes of transactions. And it's another area where buyers will want to mitigate risk and make sure that they're not paying for debtors that eventually go bad. And one thing to think about also is disputes. I think given potential rejections of business interruption claims, which is already talked about, and potential E&O exposure, I think it's certainly something to have increased focus on and understanding whether anything has really gone badly with underlying clients in terms of relationships and agreements with insurers. And finally, on transaction structuring, I think given the potential uncertainty in earnings profiles, we're likely to see more earnouts and more deferred and contingent consideration, which given potentially lower levels of earnings, might be the best way for vendors to fill any value gap which they perceive to be the gap between the value sort of currently versus a value pre-COVID. But we might see longer earnouts, and earnouts tend to be more complex, and they are a factor in increasing execution risk in transactions, and it does increase how long it takes to get deals done. So I'll now hand back to Alex, who will take us through some questions.
Thanks very much, Tom. So we've got we've got a few questions. First of all, and I think this one might be sort of going towards Charles's way, and it's Brexit related. So in our experience, how have intermediaries planned to deal with placing EU subsidiaries of UK-based clients post the 31st of December 2020 in the event of no deal?
Good question. I've seen some set up branches, and I've seen some set up subsidiaries in France and other locations where they want to continue doing European business. And the subsidiary element is important because it gives you the passport rights across the EU, whereas a branch will only give you rights within the country in which you set up that branch. EU subsidiaries of UK-based clients, I'm not really sure of that one. I need to think that one through. And perhaps if someone can drop me an email afterwards, I'll think it through with them.
Yeah, Alex, I would add to that, actually, we have been working with several brokers on Brexit contingency plans, and they are contingency plans. We don't know how it will pan out. We may not even need to worry about this if we get a good deal, but it's looking quite acrimonious at the moment, so you never know. But certainly with the brokers that we've been working with, I mean, we've essentially helped them set up an EU subsidiary to write the EU business. As Charles was saying, you have to do that for regulatory purposes. But in almost all those cases, they have kept their UK team in the UK. So the UK team has been servicing those EU contracts. But one thing to think about is the Insurance Distribution Directive, where if you have a UK team in the UK, then that's what a team in the UK, then you have to have a branch under the IDD. And with all those things, they do come with, I have to mention tax, a lot of tax issues. So if you're transferring business from the UK to the EU, you've got potentially exit taxes. If you've got cross-border provision of services, VAT. If you're big enough, you've got transfer pricing to think about, and you've also got local tax compliance to think about in the different countries. So we've done them in different countries. We've had Belgium, the Netherlands, Sweden, Germany, Ireland. So just a real range of countries as well in terms of where to go for Brexit purposes.
It is interesting time.
Yeah.
So we've got one more as well. So do you think the FCA's latest pricing policy will have a positive impact on competition in the GI market for retail customers? And then what impact will this have on the price comparison websites?
I guess that one's for me again, Alex.
I think it is, Charles.
FCA's latest pricing policy, I think it will have a positive impact on competition in the GI market, particularly for retail customers, particularly where the statistics are going to be produced, and we're going to see greater and greater realization of what underlies the service levels that are being provided by the insurers. What impact will this have on the price comparison websites? I think they're going to have to differentiate the different levels of pricing compared with the terms and conditions of the insurance, and they're going to have to highlight that in a greater way than they currently do, I think. If you go on and you look at motor and all the rest of it, there's a lot of stuff that you need to read across the screen in terms of levels of what do you call it? Deductibles, etc., before your policy kicks in. And I don't think customers really think through that. They're looking at the front end, which is the price. And I can think of an example. My son, who was looking for his household insurance, thought he had cover for his bike, and he was looking at the cheapest end of the market, and rather than thinking through what the policy terms and conditions are. So when his bike was nicked, he found that he had no cover.
It is an interesting. So one for you, Tom, if that's all right. To what extent do you think COVID-19 is going to impact transaction multiples?
I think the fundamentals of what drives multiples probably won't change. I think ultimately the higher multiples are driven by scale, and the ability to to continue to grow at a good rate. I think probably the value gaps are going to be driven through sort of short-term reductions in earnings, but I don't think there'll necessarily be a marked. We haven't seen a marked change in multiples in 2020 so far compared to previous years. So I don't think we're necessarily going to see a marked reduction in multiples, at least if things carry on the way they are. I think that there's still more demand than supply generally.
And sort of linked to that, I know there's a corporate, there's a capital gains tax review going on right now. Thomas, any particular view on what the outcome is expected to be?
It's difficult, Alex, as with these things. So the government hastily announced a review of the capital gains tax regime over the summer, and that's still going on. It's very difficult to tell what they will do, but I think one can quite safely say be one of two things. So either they increase the capital gains tax rate for disposal of assets, or they can reduce the number of reliefs or exemptions from capital gains tax. But I think there's quite a lot of fear, I think, at the moment, because if you think about not that long ago to entrepreneurs relief, when the lifetime limit was reduced suddenly from 10 million to 1 million, that was taken very badly, I would say, in the market. It was sudden and it was quite a big drop. So it's difficult to tell, but I think given the COVID-19 situation, I would say they will use it to raise taxes. Tom, I don't know whether this has had an impact on the M&A market.
Yeah, I mean, we certainly saw a sort of rush before the ER change early in the year was rumoured, and we certainly saw a rush before that, and we're certainly seeing a pickup in vendors looking to transact before the budget and before things go up. So it certainly had an impact on the level of activity we're currently seeing.
Good, excellent. One last question, which might be one for Charles, is to what extent do you think we're going to see a change in the London market due to COVID-19?
Well, that's an interesting question. And is it going to be insurance's big bang? I don't know. Certainly, electronic placing methods have been up their scale during the last few months and have proven that they can work. And the same with claims processing, etc., etc. So that determination of the market really not to embrace change and to continue to be face-to-face is maybe being challenged. And certainly when John Neal was talking about this the other day, he was saying that if Lloyd's looks the same in 2025 as it does at the moment, then it will have failed in terms of taking up the challenge that is being provided for it. He is certainly having to rethink through the blueprint, and I know that managing agents are now working on that blueprint model and entirely rethinking what the market might look like. He talked about maybe Lloyd's being a bunch of meeting rooms rather than a lot of underwriters' desks, and that will bring a fundamental change in the way that the market operates. But who knows? It's a good question, and I look forward to watching it with some interest as we go forward over the next couple of years.
Thanks very much, Charles. Well, that brings us to an end. I'd just like to thank all of those who took part, and thanks for your joining us as well. Please do feel free to ask us any more questions, and we'll get those answered. And we are going to send around the slides and a link to the recording as well. So just a sort of goodbye, and thanks for all joining us.